it is going to be almost 4 decades from now when the copyright for Eartha Kitt's iconic Santa Baby is going to free up its use in the public domain. So we can't play it today, but it got me thinking about Christmas shopping lists and what stocks ought to be on it. We'll talk about that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic. We will be taking your questions as always, and I'm just going to pull those up on another screen. But in the meantime, I thought one of the things we might want to think about would be stocks that somebody could add to their Christmas shopping list. What I have on my screen right now is a list of factors. So we're talking a little bit about factor-based investing. Basically what we're talking about here are things that one can look at that have good predictive capabilities in terms of stocks that you can purchase at the moment. Things that you can screen for. There are a lot of things that one could potentially screen. If you think about it just from a technical analysis standpoint alone, there are so many different approaches that it's almost endless how many different things somebody could try to take a look at that would help them identify stocks that they might be interested in purchasing. And there is almost as many opinions, maybe there's more opinions, on which of those are efficacious and how effective they are. However, I think it's important that when we look at different indicators, things that we can look at, that we actually assess whether or not these actually have been effective across a big set of stocks over a period of time. Now, of course, what is a good indicator at one moment may not have been a good indicator at another. And the other is that, we have different market regimes, so things can work very effectively in bull markets and maybe not so much in the investor's favor in bear markets. Let me give you an example. One of the things that I happened to identify was that over the course of the last 1 and 3 years or so, higher volatility stocks have, as a group, outperformed lower volatility stocks. And volatility isn't normally an attribute when we think about investing. We actually might prefer stability. But this makes intuitive sense that the fastest moving, higher beta, higher volatility stocks in a strong bull market might have outperformed the index overall. And so when we look at these types of factors, it's important to bear that in mind, that we can look at these things to help us select stocks, but that does not necessarily mean that a portfolio constructed of them is going to outperform in every market regime. That said, I did look at a couple different approaches to screening stocks over the course of this year to see what worked this year, to see what worked in 2024, what worked in 2023, and 2022. Just basically to see whether the performance of some of the things that I look at, how they would have performed. Would they have outperformed in those years or underperformed? And perhaps unsurprisingly, based on what I just said, the screens that I generally look at have indeed outperformed in the bull markets by larger and smaller amounts. This year, that amount has been a little bit more modest. But in prior years, it was quite substantial. And in 2022, it may have underperformed by just a little bit. And when I say just a little bit, I'm talking about maybe 19.5% through the full year. So this was looking at a universe of, I think I actually have the list of stocks up here. Let's see if I can find it. Is this the one? I had, I think it was a list of something like 38 stocks. Here we go. So this was the list of stocks that I was looking at And based on these screens would have popped up in 2022. It's probably very difficult to make it out, so I'm going to try to blow... No, I can't blow it up because when I blow that number up, it doesn't actually blow up what's on the bottom. What matters here is what the average is, and you can't see it. I'm just going to indicate. But down here, I can see what the average return for 2022 was in this list of 38 stocks for 2022, and it was down about 19.14%. So that actually would be underperforming the S&P just slightly for that year. We can take a look. Actually, I'll put, people don't actually buy SPX, so why don't we actually put in a realistic total return calculation based on, say, I don't know, SPY. That's something that people could buy. So I'm going to look at 2021, December 2021 to December of 22, and we can see here that the total return, so when you're looking at this, and by the way, I'm going to try to remember to use this annotation tool that I've been provided because I know you guys can't see my cursor. If you had taken your dividends and simply reinvested them back into SPY, 18.17%, or, and this is probably more realistic as I think about it, if you had just taken them and put them into a cash-bearing account. This, by the way, is the interest rate assumption that is being used for that calculation. And 2022, the equity markets declined because we actually had rising rates. So this may or may not actually be representative of what one would have averaged on the interest payments in a a cash account, like a money market account or something like that. But I think this is a useful exercise because what it illustrates for us is that, if you are screening on the basis of a combination of both technical factors and fundamental factors, you do get a little bit of resilience in pullbacks. So we should probably, on a risk-adjusted basis, I think you're going to be doing better. All right. So with that in mind, I thought we could list off some of the stocks that I had looked at over the course of this weekend as potential candidates. And I also had that because I wrote an article about it. Those of you who subscribe to CNBC Pro or to theoptionsedge.com, perhaps you'd already seen this list because we tend to publish these things. Yeah, here it is. So actually, let me go back. So here we are. Some of the stocks that are appearing here. Now, some of these are names that I have previously spoken of, and I'm assuming those of you who are watching already know that these are names that are of interest to me. Examples would include, and actually because this is, it's not quite black, it's sort of grayish font. What's in here, in case you can't see it. So I sort of broke this down into various categories: consumer digital platforms, travel and leisure, financials, and so on. So why don't we just start right here at the top? Two of these names, almost certainly, you guys have heard me mention before. I think both are very reasonably valued. There's a decent chance that those of you watching hold these in your portfolios already. And those are Alphabet and Amazon. And let's just talk very quickly about the reasons why I think these things remain attractive. So, first of all, fundamentals. I think this is always a good place to begin. We're looking at 10% anticipated or adjusted EPS growth for full year 2026. That gets us to $9.41 in EPS. When you look at the multiple that represents, we'll round up, as I usually do. That gets us to less than 25 times forward earnings with a 10% adjusted EPS growth and a top-line growth number of about 11%. And I just want to show, for comparison's sake, a lot of people will often say, oh, we think that Walmart justifies its multiple by the fact that they're getting increasingly into digital. These companies are not direct competitors in every area, but certainly they have a lot of crossover. And here we're looking at a top-line growth that is certainly nowhere near what Amazon's is. Now, bear in mind that I think another part of the bull case is that people are anticipating that as Walmart gets increasingly into digital, that perhaps they can enhance their margins. And in fact, the forecast is for 3.2% net income margins for full year 2026, which is certainly at the upper end of what the company has been able to achieve in recent years. But still, it's not cheap. We'll just call it $103 versus $295. You know what? We'll call it 103, and we'll just assume that they accomplished $3 in adjusted EPS. And, we could even be more ambitious. It's 10 turns more expensive than Amazon is. So they have a lot of wood to chop to get to where Amazon is in terms of valuation. So taking a look at vol, and whether this presents some opportunities here. Not hugely high vol, but it has been higher recently. This uptick that we're looking at here is a function of news. As you can see, we usually get a little bit of an uptick in volatility around announcements, and it was just recently, right here, that this is the contributing factor. Nearly 10% increase in the share price as a result of their earnings back at the end of October. I think one presses longs here, very simply. And I think that the volatility that we're seeing, you can sort of, if you go back to that vol chart, what we want to look at is this volatility in, oops, that's not what we want to see. I was trying to use the annotation tool, but it's a different one that I want to use in this case. The presumption should be that we're going to be in this post-earnings volatility environment for a while down here. And with that in mind, the white line being the implied volatility, and the curved line, that is, I should say. Let me get rid of this. This is going to make things a little clearer, perhaps. All right. This is going to be a better way to look at it. All right, so the white line essentially is the realized volatility between events that we're anticipating, and this represents the price of options, 1 month options as it stands right now. So I think that getting long and being short some options premium, not a terrible idea in that context. So let's just frame up a trade really quickly in Amazon that one could use. So this means net short options, long stock selling covered calls, long stock selling strangles, call spread risk reversals. Maybe one could just do cash covered puts. I'm a little less enamored of short put spreads, partially because oftentimes the risk-reward relationship is a little less compelling. And what we're going to look to avoid here is the next earnings release, so we know not to go that far out in time. And that's going to be February 6th, so we can go out pretty much to any January expiration should we choose. So let's just map out a couple different trades here. I mean, other than obviously just buying the stock. So what would we be Oops, I do want Amazon. Thank you, Producer Jay, for that. All right. So this is 60 days, maybe a little bit on the long side, but I actually think that's probably fine. So looking at something like that, like a 260 buy right might not be bad. Let's move on. If you're going to use a debit spread, should be probably in the money. Would be a way you could construct something like that. Let me provide an example. So this is a way to essentially get a little bit of leverage, potentially. If one was interested, again, we can look to sell something similar. So now you're paying a little bit of premium. You can adjust these strikes so that you get that break even close to spot, but here you're paying a little bit of extrinsic premium to get a bit of leverage. But the old tried and true, kind of the favorite in a circumstance like this, might actually be something like a call spread risk reversal. So long 235 or maybe a 240. We want to go down here. I like to lean a little bit more long, arguably, in this circumstance. So that's $20 to the downside. Not quite. We'll call it 233, $18 to the downside. And over here, we were just selling the 260s. Gets us a structure that looks a little bit like this. Now, bear in mind that what's going to happen here is that those wing options are probably going to decay a little bit more rapidly. And, feel free to adjust those as you see fit. Alphabet. Now, Alphabet, Google, this was my final trade on Fast Money on Thursday. We bought 200,000 shares of it on Friday on the open in one of our funds, one of the discretionary funds. And I was actually asked over the weekend, did you know the news was coming out? And the news I'm referring to, of course, is that Berkshire Hathaway announced that they had acquired 17.9 million shares. No, I did not know. I did not know that ahead of time. Would be very, very nice, of course, if I had some inside intel on such matters, but I had no idea. However, that clearly worked out pretty nicely. I think, I'm not sure, but if I remember correctly, I mean, we had the good fortune in that fund to, I'm not sure what the average purchase price was. I think I have it listed around here somewhere. Let me see. Let's see. I'm not sure that it matters that much, but on Friday morning was actually a good time to have bought it, but it was not higher on the day. I should make that point. So it wasn't a bad purchase necessarily, but it wasn't quite the purchase that it had turned out to be, in relatively short order. So I think we got an average price of about $275. And, I bring this up, disclosure or whatever it is. I don't know that it matters that much. But it was like around $275. So where are we at? Kind of traded a little weak today. So we're up about $10. It's not bad. On 200,000 shares, of course. That should help that fund a little bit. This intraday performance, I think basically this is sell the news. It would acquire. I'm not going to say Warren, but if Berkshire is acquiring 18 million shares, that has created a measure of support for the stock over the, this period of time. And I don't know if they have any intent to acquire more of it. That's a big position. It's safe to say. And they, having reported that, it's probably all they're going to be doing there. So that's not going to create quite the same support. You're not going to have this huge buyer out there. Nevertheless, it is in support of the things that I was talking about. And the point I'm also trying to make here is that even net of where we got into it and where it is right now, in percentage terms, it's it's good, of course, but it's not a huge difference in price, right? So the stocks, that's 3.64% higher than where we got into it. So same thing here. And if you want, I mean, one of the things you could do is you could say, well, I'd like to acquire the stock, but I don't want to get caught chasing, kind of like the price that you were looking at there before. Okay, fine. Go out 45 days or so and, sell the 275 puts like that. And that the amount that would pay you is effectively, very close to the amount of money that the stock has appreciated in the meantime. And the downside is that you end up owning the stock where it was before all of this came out. So, pretty... And also, I mean, just a point that, we do put money where our mouth is. So this is not, totally just a random bit of ideas, if you will. All right, so let's see what kinds of questions we have here. Yeah. I don't think we can avoid this topic. I was actually just talking about this a second ago. So the first question is from Alex V659. Bitcoin is significantly down. Major correction. What's your take? Well, the first thing I would say is it is a meaningful correction. That's not an opinion. I mean, that's really a fact. Let's just take a quick peek at what this thing has done. It has fallen precipitously from these highs right here. It's down 27% in 42 days. That is, I think, any asset that declines by that amount in that period of time, I think we can safely say that it's, that's a formal bear market. It's down more than 20%. I don't normally look at some of these other technical indicators, like Fibonacci's, for example. But what I do like about them is that it does set some price lines at levels that seem to make intuitive sense. So, for example, this shows a price of 84,000, which, as it happens to align right here with this price from whence it broke out in this most recent session, right? So if it round trips that, that's going to take us down to about 84,000. That makes sense. This is another critical level, the level from whence it broke out late last year. And I could very easily seeing that number also being in play. And that is actually a level very close to what Mark Guthner was talking about. Mark is a long-term crypto bull. He mines it. He heats his house with miners. He runs the crypto lab at Rutgers. But, we have to acknowledge that this is a volatile asset. And so he was actually pointing this level out to us on office hours last Tuesday. Now, I don't know because this is not totally current, but the last I read, the cash expense of mining one Bitcoin, the last I read, was about $75,500. So to me, I would imagine that just because that's where the marginal cost of mining Bitcoin is, that doesn't necessarily mean that it can't go through it. But it does mean that there's not going to be much incremental supply below that level. People are not going to mine for Bitcoin if it costs them money to do it. This is not a hard and fast number for every participant. Energy costs vary by participant. You have these machines. Do you want to have some revenues to offset their expense? In other words, will you operate at a loss rather than not operate at all with depreciating equipment? We've seen this in the energy space. But I would point out that, you're not going to have everybody, that there will be some marginal participants that back away if their cash costs exceed what they receive for mining. So that would suggest that this incremental supply, slow as it is, would slow even further below the cash cost of mining, which is going to be right in and around this area. But yeah, I mean, I definitely think this number here is in play. I mean, just looking at this chart, it's hard to argue otherwise. Let me just shorten this up again, so we're just looking at the last year or so, and I'll get rid of these extra moving average lines. So, you know, that's this level right here. 86.6. That definitely would appear to be in play. This is, yeah, I mean, there were a couple critical levels. I think I showed this on an earlier show. I'm pretty sure I did, but let me just, as a refresher, the thing that I had been looking at was the 50-week, oops, why is that not working? 50-week moving average. So this is right now, it's on dailies. We're just going to go to the weeks, like this. I'm going to get rid of these two numbers because they're not really relevant. And you know what I was saying is that sure, we had touched this a couple of times since 2023, but we had at no point closed definitively below it, come back and retreated. We have done that now formally right here. So it has definitively broken its long-term uptrend that has been in place since the beginning of 2023. So it's basically a 3-year uptrend that we've had since actually the tail end of 2022, and it has definitively broken that. Okay. Steve Garcia, Carter Worth today on Risk Reversal showed some charts that suggest Bitcoin hit a major trend line going back at least 10 years. This area, 92,000, right now is a key level. I'm assuming if he was looking at a 10-year trend line that he was probably looking at a logarithmic one. And let's do that then. And please, by all means, if this looks at all like what he was showing, I would certainly be interested in knowing that. And we can draw a little line in here as well. I don't know what... I assume that's what he's referring to. And I would agree. This is quite critical. So by this work, let's just drag this a little bit. Actually, I'm not sure I really drew that well. Let me delete this for a second. Hang on. Let's try to get this thing looking as good as we can get it. If we're going to try to decide whether something is making or breaking, we want to be as precise as we can, I assume. So, yeah, please, Steve, if you know, is that the... Yeah, okay. So, Steve, you're responding. It's a free YouTube podcast. Everyone can watch it. I'm sure that's true. I think I'm not sure if I think I've done some stuff with Guy and Dan maybe on the. I think I was on that a while back. Yeah, I mean, depending on where you put the back half of this line, that's the level. That's the level where we're at. And look, I mean, from my perspective, I've said many times I'm not a technical analyst, but that does not mean that I'm not like every other person who looks at the markets, that I ignore charts. I don't ignore charts. I do look at them. And I try to see, and I tend to look not at obscure things. I'm sure there are people who have all kinds of fancy charts, but I just try to look at the things that most people are looking at. Whatever is the most broadly and widely accepted indicators are the things that are going to matter. The thing that we can quickly and easily draw with our mind's eye, or a chart and a ruler, and we can connect some lines and some dots. And the reason is because there is a self-fulfilling element in this, and that is that investor psychology, being what it is, if people feel like it has definitively broken, that will very likely introduce incremental sellers. And indeed, we are very, very close to that right now. So, yeah, I would agree. This is very much a key level. Joseph Kamen 19. Hi, Mike. Happy Monday. With Bitcoin near a death cross, does that hold any import to you? Death crosses? Not really. It sounds dramatic, though, doesn't it? So let's just take a look. It is across that, as we can see here. But let me go back a little ways. And maybe this will help give some reason to why the death cross may or may not be that important to me. And that is because I'm not sure how exceptional it is as a timing tool. So we have an opportunity here. This was a death cross. 50 goes across the 200, and you turn seller in June of 2021 at best case. I mean, what is that? 40,000, kind of a best case. And then a golden cross back here. This is September of the same year. Best case, you're in 10% higher. Then another death cross over here, and now you're turning seller, what, 5% lower? So not a great trading tool or indicator, at least in this section here. Okay. We got a golden cross over here. Means you turn buyer at, we'll call it 25,000. But then you sell it over here at about 30. Not bad. And you're back in around the same level. That was a winner up until about 60. So, okay, good trade. You're out. Then you're back in. You're back in. Probably about 10% higher at least. And then you're out. Here, this was definitely not great timing because the death cross, and that's the other thing. These death cross has, death is a permanent thing, but the death cross happens all the time. You know, it's like a video game with I'm not sure how many lives. One would have been a lot better off just simply holding it through all of this, probably, than tinkering around with these things. Instead, I would be more interested in, okay, were there any technical indicators that perform better over this period of time? And if so, what were they and how did they do and what are they saying now? So if we go back 10 years, probably buy and hold would be the best thing you could do. And it looks like that's the case. We're running a simulation. We will soon see. No, actually, a weighted moving average. That's interesting. So the weighted moving average and the simple moving average were, well, the weighted moving average really outperformed. Look at that. Actually, kind of surprises me, to be honest. Let's take a look at what that one says and where those indicators are. There's a lot of indicators. So, this is 10 years worth of data, probably too much to look at. I actually, you know what I should do? I should put this just for this year. Here we go. So the previous trigger took place back on October 30th, and this one is now bear. Okay, so it was bearish as of. Am I seeing that right? Let's shorten this up considerably so I need a little bit more resolution here. Oh, okay. So this actually reversed. I apologize. I had that first one long. So it went long on the 28th and then immediately reversed on the 29th. Closed and went short and has not done anything since. That was on October 29th. So, yeah, I mean, the death, again, this is just to answer the death cross question. I find it interesting. It sells well. That is to say that people hear, oh my goodness, it's a death cross or it's a golden cross. I feel like it gets a lot more mention in the news than it does probably amongst traders. I've never heard one trader mention it to another. But I hear it a lot. Probably got mentioned on CNBC today. We can look that up maybe. You know what? Let's see. Let's find out. See if there's a news story. Samsung. And let's put Bitcoin in here. Golden Cross forms death cross. No. No stories about it today. In some ways, that kind of surprises me. But, yeah, no written stories, but you can check out CNBC. Maybe they... Oh, I'm just hearing somebody who has one? Yahoo Finance. In the last 2 hours, so... Yeah. Bitcoin death cross. Death cross confirmed. There you go. Bottoming or about to crash. So, and then 4 hours ago, Bitcoin sinks to 6-month low as death cross hits and fear spikes. So who was saying that? That looks like that was at the office closest to me. Yeah. So if you're wondering, if you're looking at this, that is from the One Market, that's the CNBC One Market studio. That image right there, which is probably about 5 miles as the crow flies in that direction over my right shoulder. That's the Bay Bridge behind it. If we went out on the front yard here and looked in that direction, you'd be staring down towards Salesforce Tower. That's where that is. Yeah, I mean, it doesn't really... It's not that hugely interesting to me. What is more interesting to me is where the stock or the underlying asset might eventually find some measure of support. And I think that the first measure of support is probably going to be in and around 86,000. And I think the second, it was mentioned twice on CNBC by Maria Segallo. Thank you for that. And Donovan Young, same thing, mentioning that it was on CNBC today. I knew it. They love that's. Look, this is not a knock on them, by the way. Some people care, and it sounds dramatic. So, do you ignore it? If it makes a death cross, do you not report on that? I mean, I feel like they're probably compelled to do so, but is it something I pay attention to? No. What I do pay attention to, though, are those three things that I just mentioned, which are, I think that first measure of support is that level from whence it broke out. That's about 86,000. The next one is the marginal cost of production, which my most recent data has at around 75,000 is the cash cost on average. So that's also where you start to see a fall off in incremental supply. Not that the incremental supply of Bitcoin is so massive, but it's just worth noting. And that also happens to be another technical area of support, which Mark Guthner had mentioned for us last week. So those are really the things that I'm looking at personally. And I don't see at the current level any reason to reach out and pay 91, 92,000. I could see picking some up at 86,000, and I certainly think that there's meaningful support down in the mid low 70s. So I hope that helps. But yeah, I'm happy to any charts you guys want to look at. I'm happy to pull them up. I mean, I'm always interested, even if it's not something that I look at. Maybe I'll become interested. Maybe you guys can show me something that I haven't looked at, and I think that makes some intuitive sense. But I also think that when it comes to technical indicators, to the extent that there's a self-fulfilling effect, they need to be broadly looked at. Anything beyond that, and I think you might as well, pull out a Ouija board or something. Okay. So, Steve, you're saying, do you think there's a compelling case to buy and hold crypto treasury companies like Strategy, Bitmine Immersion, Mara, and SBET? Okay, so first things first, we had in one of the funds we had and do have, I believe. We still have Bitmine Immersion in that one. Just double check. My long-term view is still bullish on these things. Do we have Bitmine Immersion in there still? We still have some mining. We do not have Bitmine Immersion in that one, but I believe we do in LFGY. Yeah, not a huge amount of it, but we've got 138,000 shares of Bitmine Immersion, along with a lot of other things in the complex. Look, as I've previously stated, I think that strategy becomes very interesting as a play to the upside when we really feel like Bitcoin's kind of bottoming out. And the reason for this is because I believe it still has some upside leverage. Bear in mind that there's about 10... So if you hear somebody saying, oh, it's basically trading at the liquidation value for their current Bitcoin holdings, and Saylor was on last week, so let's see how much they say they're up to now. He was on CNBC on Friday before I was, so I didn't actually hear him saying that they were acquiring. Oh, okay, so almost, all right. So now they're up to, well, this is nice because it works out to a nice round number. They've got about 650,000 now. So that's, yeah, they're up about 9,000 from what I had. So 650,000 at, what we got here? At 92. Call it 92,000. Nice round number. So we've got about 59.8 billion. And so if we take a look at the market capitalization plus 10, gets us to 66, because that's about the value of the converts, of what is convertible. So that's, I'm looking at it kind of like on a fully diluted basis. So that's 66 over 59. Remember that I said, do you want to pay like a 10% premium in strategy to make a bullish bet? I don't think that's bad. We're not far off of that now. It's about a 12% premium on a fully diluted basis. And again, these are rough approximations, but we should use rough approximations because you've got multiple moving pieces. We've got the equity moving. How much Bitcoin do they actually own? And they've been acquiring some. Their issuance, and then the price of Bitcoin itself. So you kind of, you could put it into a spreadsheet and model it, but we're getting close to a point where I think that it's probably worth just taking a punter on, especially if Bitcoin. So where would those levels be? Actually, you know what? Let's do that exercise. Okay, let's do this exercise. So, because I say these things and then I'm not sure that it all translates. So let's think about this. Okay, so what do we know? There's about $10 billion worth of convertible debt. That's the preferreds and the zeros on Strategy's balance sheet. So what we're really looking at is, let's assume they have 650,000 Bitcoin. And let's assume that Bitcoin gets down to, what did I say, 86,000 was that first line. So we'll just call it 86,000 is the price for Bitcoin. So that's going to be this times that. All right. I'll blow this up a little bit so we can see it a little better. Or blow it up a lot so we can see it some better. Okay. So assuming Bitcoin gets down to this level, which is that first point, that would get us to $56 billion in the value of their holdings. We know that they have about $10 billion in convertible securities. So I'm going to reduce, in order to figure out what my premium is going to be, I'm going to reduce by that amount. So that essentially means it's going to be this minus the $10 billion, because those are debt instruments. Like, they're not really floating. So now we're down to 45.9. So that is essentially the value of the equity if you're paying one up. So that's essentially the liquidation value. The debt gets the convertible debt gets satisfied. And that works out to, so now we can just say that's the market cap, and then we just can quickly see what the current market cap of Strategy is. And then we can quickly see what a discount would be. So that's down 18% from here. Now, on the other hand, that's at 1-for-1. But if I do think that it's worth paying, say, 10% more than that, then that's going to be equal to this times that. Gets us to 54.90. Which I do think it is. I mean, so that's like down 10% from here. I would add at down 10. Just knowing that you're paying a small premium for their flexibility, let's say. And just to put things in perspective, we were just looking at the stock. So that's, let's use round numbers. That's 180. And let's actually take a look. Since we were just doing it in the other thing too, we might as well do it here too. Is there anything that we can see on the chart that looks interesting at about that level? Hard to tell since it's... That is in and around, so that's going to be in and around this level right here. That doesn't look like it's a particularly important level on this chart, but this is more of a play on Bitcoin than it is on Strategy. So, yeah, I mean, so my thinking is, the reason to play Strategy rather than to play Bitcoin itself is you're looking for the possibility. It shouldn't trade at a material discount to the value, to the book value of the Bitcoin they hold. So that's kind of the backstop. So if you're thinking, okay, I want to be in it anyway, but there is a chance that you get some expansion, like you actually get a multiple or a turn to the upside. And so that would be the principal reason that I would be interested in playing Strategy. We know that it has traded in the past at a premium. Doesn't mean it can't trade at a discount, but it's not that likely. Because most folks are going to look at it, and there's going to come a point when, if that thing traded at a 30, here's an example. If it traded at a 30% discount on a fully liquidated basis to the value of their Bitcoin holdings, what would happen? Somebody would say, okay, well, I'll take a short position in Bitcoin long strategy on the idea that that's going to converge. So ARBs, I think, would start to play if you started to see a discount. So that does begin to create a little bit of a floor. On the other hand, we do know that it has traded at a premium in the past. So to me, the principal reason that I would be interested in owning strategy rather than Bitcoin itself is because I have that little extra, gearing to the upside. In the event that you start to see a premium to the underlying asset get introduced, you get some play on that. So it's sort of like a levered or geared play on it. So that would be the principal reason. But otherwise, of course, to each their own. You can always just go out and get the crypto yourself. But I actually think that there is a reason to play here. And I'm not alone in that. I think maybe our crack production staff can check this. But I'm pretty sure that JP Morgan came out with... it might have been JP Morgan. It was one of the bigger banks had come out essentially making that same point. That you have two ways to win, if you will. Like you could see that kind of multiple expansion that they trade at a premium to the value of the book value of the underlying crypto that they hold on their balance sheet, and also, to the upside of Bitcoin itself, right? So if Bitcoin rallies sharply, then we would expect strategy to rally sharply. And if they're once larger margin relative to the book value of Bitcoin came back, there too. That would be a benefit. Now, one other quick thing I would just point out. They do have a bit of debt on their balance sheet, so, leverage can cut both ways. But, I just make that point. All right, so... 11506 Steven, VIX is at 22 and Fear and Greed Index at 17. You think high beta stocks can recover if NVIDIA earnings are good? Yeah, I think I've shown this before, and did I have this up? Of course I don't have it up right now. I have a little VIX versus S&P return thing that I look at from time to time. Hopefully I'm pulling up the right one. Is this it? Yeah, okay. So, one of the things that we do see is that when the VIX gets elevated, the average returns for the S&P will tend to be better in the 30 subsequent days thereafter. And that's because the VIX is a little bit of a contrary indicator. What you end up with is... Let's see. What you end up with is kind of an oversold condition. And one of the things that I found was that generally when the VIX got over 25, that was definitely helpful. Where did we close today? We're not quite there yet. But if you're looking at my screen, you might see that I have an additional indicator in here. And this is not something I look at every day. It was actually, the purpose in this exercise was that, I get asked this question occasionally. And one of the things I said, you know what, I'm going to examine something else here. And this is the part that I think matters. And that is, the VIX can be 25, but is it 25 up from 22, or is it 25 down from 35? And so the short version is that when it gets over 25, the 30-day returns in the S&P, on average, are substantially higher than they are in the general case. But it's less true if you're still on your way up than if you're on your way down. So So I would bear that in mind. And this makes sense because the VIX often crosses through 25 on its way to 40. Maybe you just wake up and it's 40, but that's not usually the case. Volatility rises, so if you're still on the upswing, there may be some more pain ahead. That's the short version of what that tells you. Are 30-day returns better on average? They are. But it is also true that some of the worst incidents have taken place in that realm when the VIX crossed over 25 because a lot of bad news is breaking all over the place. So, in general, do you do better if you buy when the VIX is over 25? The short version is yes. But you're also going to have a much bumpier ride, which is exactly what the VIX is telling you anyway, because the VIX is a 30-day forecast of volatility. But, those are the considerations I would just give some thought. Okay. Mike, the chart you displayed on SPY was very clear and visible. Okay. Was that a chart or was it a table? I'm not sure what I was showing, but in any case. All right. What would you think of a ratio put spread on strategy like it? Oh, let's build this. This should be good. Let's pull. This is always a worthwhile exercise that we can actually work a trade up. So you are looking at the DEES 190, 170, 1x2 put spread. I like that. Well, I think I like it. I haven't looked at it yet, but I like where your head's at. So what are we looking at here? We're just going to go to, and were you looking at DEES regular? Let's assume it's DEES regular for now. So buying the 190 puts, and then selling 2 of the 170s. You're saying that could be done for a credit right now? Oh yeah, look at that. Well, that's kind of interesting. So your downside break even in this case is going to be 148. So you're effectively going to get net long. If everything goes against this trade, you're net long at 148 versus 195, which is down 24%. We have a little bit of leverage to Bitcoin. So if you think about what does that translate to in Bitcoin terms, we'll say that that's 0.8. It's 73.6. So your risk is, let's think about this in Bitcoin terms, that is not much different than taking the risk that you get long Bitcoin at 73.5, 74,000-ish. Oops, what's going on here? I hit a wrong button, sorry. Which is right near that other area that we were looking at down here. So effectively what you're doing, I would say that by putting that put spread on, you're going to collect $2 or about 1% of the stock price in 1 month. If MicroStrategy declines and Bitcoin stays above this level, you actually could see more material profits. So as long as it stays above here, then I think that trade works out well. I like it. Let's go back and take another look at it. Let's let everybody look at it so they can get a nice, let's do this. I like that trade. All right, just so everybody's paying, this is what we're talking about, okay? The December 190, 170, 1x2 put spread. Buying 1, closing price, midpoint, 15.8. We'll just call it 16 and $9 to keep the math easy. Okay, so I'm looking over here. Buy the DEES 190s, pay 16. Sell 2 of these 170s at close to $9 each. Net premium of $2. And, again, using that same methodology that I was talking about, like where I think the value of strategy should be relative to the value of Bitcoin, that's a close to 24% decline in strategy, which also happens to correspond approximately, not exactly, but approximately, with exactly. So you acquire, so exactly right, Steve. So what Steve is saying here, so you acquire MicroStrategy at 170 less the credit of $2. So you effectively have a basis of 168. And a downside, you have a downside break even of 148. Right? So that's essentially the way to think about it, because your basis is not the $2 credit, actually. So let's be clear about this. Your basis, why isn't your basis? So you're collecting $2, but you're net short the 170s. Why is your basis not 168, 170 minus the 2 you collect? Because actually you're going to make 20 on the way down between the 190 and 170 because you're long the 190 puts. So at this lower strike price, by that point, you've already collected $2, but now you've also made an additional 20 because you have the 190, 170 put spread. You're short that additional put. You take that 170 minus the 22, the 2 you collected plus the 20 you just made on the put spread. That takes your effective purchase price down to 148, which is the reason why that is the downside break even, as we can see right here. Hopefully that makes sense. Okay, so that's the cool thing about these 1x2s, is that, if you collect premium, that reduces your basis on the shares you might be forced to that you might be compelled to purchase if the stock is put to you. But you also, by definition, will have made $20 on the put spread that you own. So if you kind of think about it that way, like it's a long put spread plus a short put, or if you think about purchasing a put spread financed by a short put, so that's going to get your basis down to that 148 level. And that's the reason why when we're looking at a trade like this, we're looking at that. Oops, I brought the wrong chart back. That's the reason that we're looking at these levels down here. So, you're effectively going to own it at a much lower price. So that's essentially the risk you're taking. In my view, the way I just sort of modeled that, I'm saying that if you did a trade like the one you suggest, you're going to collect 1% of strategy's cost on a standstill basis. So not a terrible outcome. Not a great outcome, but not a terrible one. If it declines, if it falls by 10%, you could actually have material profits. And in the worst case, you're going to end up, taking the risk that you're getting into a levered long Bitcoin position, down at that lower fib. So I hope that helps. And we have chewed up an hour, so I'll let this be the last question. And I'm afraid I'm going to put it up, but I'm not sure I can answer it. What does the IRS think my cost basis would be if I'm assigned? Just 170. So the way that's going to work is it's probably going to be seen as different transactions. You are going to have, I think you're going to, you probably want to check with your tax accountant whether you're able to book it that way as a lower cost. The ideal situation would be that in the worst case, if you're put the stock, what you want to have happen, unless you have losses this year that you're trying to offset, the preferable condition in a vacuum would be that the basis on the shares would be that lower price. I sense, though, that it's more likely in most cases that you're going to have a realized short-term gain and in a higher basis. So that's my suspicion is that's not going to be optimal from a tax perspective. But, check with your experts on that. IRS wants to adjust the purchase price by the cost of one put, and another one is a short-term Oh, okay. So Alex is saying the exact same thing that I just did. That's what I believe the treatment would be. Unfortunately, our preference would be the lower basis, of course, because it wouldn't have an immediate tax impact, and to the extent that there was one, you could essentially defer it and maybe even convert that to a long-term gain in the subsequent year. But unfortunately, that's not the case. Yes, as producer Jay wisely said, whatever your preference would be, that's probably not what the IRS will allow. That's my guess too. I mean, also, some of you may actually have trader status, which is that, if you're trading very regularly, that, you have this as an occupation, and that will tinker with your results as well. Anyway, yeah. And Steve, you also believe that Alex is correct. I mean, this is consistent with how I would imagine it is going to take place for most investors. Nevertheless, Alex is right. I'm a CPA, Monday morning quarterback. Thank you for that. Yeah. So it seems like we have some sort of a quorum here on this. Again, everybody's circumstances might be a little bit different, so optimize as you see fit. But ignoring the tax consequences or implications, this does seem to me like a potentially attractive point to get long, and maybe even levered long, which that 1.2 put spread in strategy would essentially be accomplishing. So great questions today, very thoughtful, and even got me thinking about it, because I didn't come to you guys with that 1x2 put spread. We can thank one of the viewers for that. But that is indeed very interesting, and I will be looking at that myself. I've chewed up a little more than an hour. I thank you guys for your time and attention and your very thoughtful questions. Please tune in again on Wednesday, 4:15 Eastern. We will be back, and hopefully we'll be doing office hours with Mark tomorrow. We'll see you soon. Thanks for watching.